Ladies and gentlemen, good afternoon. I want to talk a little bit about the financing of Portuguese economy, particularly in the context of the response to this unprecedented economic crisis which followed the pandemic of COVID-19. The impact of the measures that around the world the governments have taken to contain the spread of COVID-19 has been terrible in terms of social and economic impact. Actually, in the case of Portugal, during the second quarter of 2020, when containment and lockdown restrictions were at their peak, GDP contracted by 16.8% in comparison to the second quarter of 2019. For the year end, the Bank of Portugal just came out with its forecasts. GDP will contract in comparison to 2019 by 8.1%. And in the next year, the good news is that GDP is expected to rebound by 5.1% and get to the levels of 2019 by 2022. This highlights the importance of the measures that governments around the world have taken in order to contain the impact of this crisis and make sure that economies are better prepared to have a strong recovery during next year. This, of course, will all depend on the evolution of the sanitary situation, but for the moment, these are the measures that have been taken. In the case of Portugal, we have passed a very strong furlough system which has helped to support employment in companies which were otherwise impacted by a very significant contraction in demand, and we have been significantly extending and adjusting these schemes to the new economic situations. We have extended credit lines guaranteed by government to tens of thousands of companies, micro companies, SMEs, large companies, to make sure that the cash flow continued to be available. We have passed moratoriums so that companies are able to withhold payments to the banking system for an extended period, thereby also alleviating the cash demands on companies. And we have passed emergency measures, extraordinary measures, to support those who have been left without any income, whether by effect of unemployed or the self-employed, which have seen no activity. All these measures have meant that although GDP has contracted very significantly, disposable income and employment has held its own. And until now, the society and economy have been holding very well. Now, these measures and the efforts that we are making to support the economy and society and disposable income of families come at a cost. We expect that governments will be, which are making a huge efforts across the world, will take a significant hit in terms of public finances. Portugal expects to reach the year end with a budget deficit of around 7% of GDP. And we also expect that public debt as a percentage of GDP will grow to 130%, which is a very large number, which we had hinted at the height of the previous crisis and have been reducing sustainably for the past 5 years. Now, the good news is that forecasts anticipate that at the worst of this crisis, we will still be well above the worst moments of the previous global financial crisis, which means that we are better prepared. But as I said, this comes at a cost. This comes at a cost also to companies, which will be hugely indebted and will see their equity erode by negative results this year. So we need to provide responses on both these fronts. In respect of governments, we hope that the the public debt is now at a sustainable cost, given the measures that central banks around the world, and in particular the ECB, has taken. There are no structural measures that we are incurring, so that the extraordinary expenditure that we have taken to respond to the crisis will not be repeated. And the fast growth of the economy will be the better solution to this growth in GDP, which is why we must take appropriate measures to stimulate the economy by making use of the funds made available by the European Union to invest not only in providing immediate stimulus, but laying the groundworks for our future prosperity, for a future which is more productive, sustainable, and inclusive. And for companies, we must address the solvency concerns. Even as liquidity issues have been so far resolved, we must make sure that we don't have a solvency problem next year. And we are working with the financial system and all the communities to come up with capitalization solutions for companies more effective, which are critical to our future growth. The ways we are going to make these funds available, whether for capitalization of companies, whether to support the future investment, will be diverse. Government will continue to provide the role. We have just approved the creation of a development bank which will support our economy and our companies making the necessary investments. But I think that critically, capital markets will have to play a greater role in the financing of companies. The banks certainly have a topic, but banks are constrained in in extending credit to companies going forward, given capital requirements, their cost base, and also the fact that long-term investments which are needed in the future will be difficult. But if we are going to develop the capital markets for the companies, we must appreciate that in Europe, SMEs make almost 99% of all the companies in Europe. So we must make sure that capital markets provide appropriate solutions to these areas. And I'm looking forward to working with supervisors, working with the industry and operators to make sure that we have more robust capital markets which can play a greater role in financing our economy and making sure that the savings of the Portuguese are allocated to the financing of the Portuguese economy. Thank you, and I hope you have a fruitful discussion.